Okay, in this video we're going to be talking about a credit card statement. Now, credit card statement is what you're looking at right now. This is an example of one, and you can see all the little arrows. I'm about to show you exactly what all those are pointing to, but this is a statement that you will get every single month if you have a credit card. This is very similar to a checking statement that you get every, or a balance statement at the end of every month. So it's very similar. And so like very basic, I'm just going to go over this. Up here is all the account information, like maybe when everything is due. But everything down here represents all the transactions or all the activity. All the activity means what you have done. What have you done throughout the month that deals with a credit card? So like for example, the gift shop, if you notice, $75, the pizza place, $31, and then so on and so forth. But the payment here, if you notice, the payment's also on here as well. And the payment will always be as a negative. And the reason why it's a negative is because when you're paying off a credit card, you're taking away debt. So with a credit card, every time you use it, you add debt. So when you make a payment, when you start paying it off, you take away debt. So you'll usually see it in a negative number. So just keep that in mind. All right, now here's a couple of things here. Down here, oh, maybe I should have done this. Okay, I know you can't see it all, but just bear with me a second. All right, down here on the kind of the shaded blue area, this is the summary row. This tells you everything that you need to know about this particular payment, or statement. So just a couple things. First off, looking at our payments and credits, see it's $75. Well, there's your $75 right there. All right. Now, the new purchases, that means how much you bought, meaning how much you put on the card. Now, you can take $75, 31.85, 39.10. You can add all this up individually, or you can just look at your new purchase line. So if you were to just add all this up, you'd get the new purchases. So there's no need to add it up when you have the new purchases. There it is. The late charge, the finance charge. This was on the last test here, or I'm sorry, the last video. Now remember, in order to get the finance charge, and everybody's going to mess up on this, is you take the average daily balance and you multiply it by the monthly periodic rate. All right, if you multiply those two together, you will get your finance charge. Okay, that's the one thing that students seem to have the most trouble with. Okay, now let me actually kind of show the rest of it here. All right, the previous balance, this represents how much was on the card the last month. So apparently the owner of the card, I think it might have been Jane Sharp, she did not pay off her credit card bill in time. So that 150, or she didn't pay it off totally, that is. So $150.50, that's what rolled over from the previous month. Now remember, when you have a previous balance, you're always going to have a finance charge. Okay, so when you have a previous balance, you're going to have a finance charge because the finance charge is what they charge you for carrying over your bill and not paying it. All right, now let's get going. Example number one. Explain how the new purchases amount was determined. Well, the new purchases were 284. Well, going back to your credit card statement, I know there's a lot of writing on here, but if you just add up all the things that you bought, that's how you get 284. So the answer to that question is new purchases, well, it's what I bought. Now, explain how the new balance amount was determined. Now, I wrote this thing right here, and this works, but that's a lot of writing. But if you want to look at it this way, this might be easier. Okay? Now, starting with the previous balance, if you were to subtract the payments, add the new purchases, add the late charges, let me put a little more plus on that. There you go. Plus the finance charge, that will equal the new balance. Now, the minimum payment, this is kind of not really, it's not important when it comes to the new balance because the minimum payment is just the credit card company saying, hey, listen, if you can't afford the new balance, then you just give us 20 bucks. That'll be the minimum payment. That's your minimum responsibility. So starting with the previous balance, if you subtract the payments, add the purchases, add the late charges, add the finance charges, you will get the new balance. If you can remember this setup, then all this right here you won't need to know because you're doing it right here. All right, so let's try one. Okay, this guy has a credit line of 15,000. All right, we'll talk about that in a second. Now, starting with the previous balance. Notice what we have here is up at the top here, we have a problem with the new balance, but all of a sudden, hey, the new balance is not there. That's what we got to figure out. So remember, previous balance, starting with that, subtract the payments, add the new purchases, add the late charge, add the finance charge to get what it equals. And you get $1,992.45. Okay? Now, that's great that you found the new balance, but unfortunately that's not what the question was asking. The question is asking is how much available credit does he have left? Okay? Now, to answer that question, let me go back to the credit card statement. Okay? And let me kind of clear all this out so we're not looking at a bunch. All right. So, the total credit in this example is $8,000. Okay, $8,000. I'm not going to box it in because I need that number behind us. The total available credit is $7,636. Now, what a credit line means, this is how much money a credit card company will let you put on their card. In other words, that's the amount of money that the credit card company will let you borrow at one time, $8,000. You cannot go above $8,000. Okay? Now, Jane, in this example, Jane Sharp, that's where I'm getting the name, just in case you didn't know. Jane has $7,636 left. Okay? Now, there's a difference here. 8,000 to 7,000, there's a difference here. The difference is the new balance. See, Jane already owes $363. Okay? So the question is how much available credit, what's left? How much could she still put on the card if she chose to do that? Well, that would be $7,636. So applying that to this principle here, if this guy, I want to say Pascal, but it's not it. If this guy has almost $2,000 already owed, meaning he's got to pay that money back to the credit card company, how much available credit does he have left? Now remember, the credit line is $15,000. That's the max that he can spend. Well, he's already spent $1,992.45. So I know I'm writing with my mouse. It's horrible. So the answer is how much available credit is left? We'll just subtract them. So 15,000 minus the $1,992, and you end up getting, I'm going to type this because it's easier for me to type, and you end up getting $13,007.55. That's how much credit he has left. So if he wanted to put more money on the card, he could, and this is it, 13,000. That's how much he had left. All right, example number 3. This person is examining the summary section of a credit card statement, and she's checked all the entries and determined where the error was made. So apparently we know there's going to be an error here. Well, remember, starting with the previous balance, minus, plus, 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 does that equal the $2,576? And the answer is no, it doesn't. It ends up equaling $2,476.15. Now it asks, determine where the error was made. Well, the error was made is since there's a difference of $100. I'm thinking the reason why it's a difference of 100 is because of the fact that maybe the payment or credit, maybe it was recorded but not applied. So that would be that. Now, the last one I want to do, and I'm about to run out of time here, and that is this example here. And I know it's already filled out, but I just want to highlight this one more time. The finance charge. The finance charge is always found by taking the average daily balance and multiplying it by the periodic rate, the monthly interest rate here. That's how you find the finance charge. And the reason I'm highlighting this again is because students are going to mess up on this. Okay? So the average daily balance, if you remember, going back to the last video, that was that whole, 4 days by $500, 6 days by $600. And then you divide it all out, and then the monthly periodic rate. All this is just given to you. So all you have to do is just multiply these two numbers to get the finance charge. That's it. Now, if you have any questions, please let me know the next time you see me. Thank you.